Micron dropped 6.7%, and everyone is panicking. Our proprietary model assigns Micron an 80-point lab score, quantifying a severe supply-demand imbalance that Wall Street fails to capture. That gap fuels pricing power, expands margins, and underpins a multi-year earnings runway. But the lab score is 80 out of 100, strong buy. Here's why the sell-off is wrong. Micron sits as a Tier 2 beneficiary in the AI supply chain, the memory layer, currently in a peak phase. Micron's 6.69% plunge to $1,132.33 has shook the market, wiping out billions in paper wealth while Western Digital rallied. We rated Micron a strong buy at $1,133.99. Flat performance since that call confirms our thesis that short-term volatility is a consolidation phase, not a structural breakdown. The immediate catalyst for MOVE is a wave of profit-taking following news of Micron's massive $100 billion AI deals. This capital rotation is happening against a backdrop of extreme fear, with the market sentiment index sitting at a low score of 18. While retail traders panic over the daily red candles, institutional volume over the past 5 days is 20.6% above its 20-day average. This indicates that smart money is quietly buying the dip with high conviction. The market is currently pricing in a rapid cyclical recovery, fueled by an 82% year-over-year revenue surge to $6.81 billion in the. Furthermore, gross margins swung from negative 17.8% to positive 28.1%. Wall Street is betting that DRAM, dynamic random access memory, the volatile system memory that holds active application data, average selling prices will continue to climb. But the real tension lies in the consensus expectations. Analysts are projecting a massive EPS, earnings per share, the portion of a company's profit allocated to each outstanding share, beat streak to continue after Micron beat the last estimate by 17.3%, delivering $25.11 against expectations. The casual investor sees a stock down nearly 7% and assumes the AI bubble is bursting. The institutional investor sees a temporary valuation reset in an oligopoly. To understand if this dip is a buying opportunity, we must look past the financial spreadsheets. We must analyze the physical constraints of the silicon itself. Does the underlying physical engineering support these aggressive margin targets? Or are hardware bottlenecks about to derail the entire growth story? To answer this, we must look at Micron's core technical architecture. The foundation of Micron's current margin expansion is its industry-first transition to the 1-beta DRAM node, the 5th-generation 10-nanometer class manufacturing process. Micron achieved this transition without using EUV, extreme ultraviolet, the high-cost lithography technology that uses short wavelength light to print microscopic chip features. Instead, they used advanced multi-patterning immersion lithography. This engineering decision saved billions in front-end capex, capital expenditure, the funds used by a company to acquire and upgrade physical assets. This node directly powers their HBM3E high-bandwidth memory 3rd generation extended, a high-speed stacked memory interface used in AI accelerators. Micron's HBM3E features an 8-layer and 12-layer stack. It delivers over 1.2 TB/s, terabytes per second, a unit of data transfer speed representing 1 trillion bytes per second of bandwidth. This replaces the traditional slow memory bus with a massive vertical data elevator. But this architecture faces a brutal physical constraint, TSV, through silicon via a vertical electrical connection that passes completely through a silicon wafer or die. Packaging 12 layers of silicon requires perfect alignment. If a single TSV fails, the entire stack is scrap. SK Hynix currently holds a 12 to 18-month lead in packaging yields using MRMUF, mass reflow molded underfill, a packaging process that uses liquid epoxy to seal stacked memory dies. Meanwhile, Micron relies on thermal compression non-conductive film, which has lower initial yield rates, but offers superior thermal density. In the storage market, Micron's 232-layer 3D NAND, three-dimensional flash memory, a non-volatile storage technology that stacks memory cells vertically to increase density. powers the 6500 iWin 30.72 terabyte enterprise drive. This drive dominates hyperscaler data centers due to its low latency and high density. The engineering reality confirms that Micron's physical architecture is superior in power efficiency. However, the manufacturing yields of 12-layer HBM3E remain the ultimate bottleneck. If Micron can stabilize these yields, their 28.1% gross margin is just the beginning. The physical reality supports the market's long-term bet, but it leaves one system-level question open for the macro landscape. Quarterly financials showing modest revenue momentum for Micron. By the fourth quarter of 2026, normalizing monetary policy and escalating trade tariffs will compress Micron's valuation multiple by 15%, even as structural AI demand remains red-hot. To understand this friction, we must look at the monetary landscape. The Federal Reserve's current interest rate of 3.63%, combined with a normalizing yield spread of plus 0.31%, has transformed the cost of capital. While prediction markets place the recession risk at a low 8.9%, the high interest rate environment directly pressures Micron's capital-intensive business model. Micron requires massive upfront investment. Building leading-edge memory fabs, semiconductor fabrication plants, the highly specialized factories where silicon wafers are processed, requires billions of dollars before a single wafer is spun. The current 10-year yield of 4.40% means debt financing is expensive. This directly impacts Micron's cash flow, especially as they fund cleanroom expansions in Boise, Idaho, and Clay, New York. Fortunately, policy is acting as a powerful counterweight. The federal government has stepped in with a $6.1 billion CHIPS Act, creating helpful incentives to Produce Semiconductors Act, a federal law providing subsidies for domestic semiconductor manufacturing grant. This funding is designed to de-risk U.S.-based leading-edge memory production. However, this government support comes with strict regulatory strings. The 2024 U.S. export control rules restrict sales of advanced memory chips above 24 gigabits to Chinese data center customers. This policy directly cuts off high-margin revenue from Chinese hyperscalers like Alibaba and Baidu. Micron is forced to divert its leading-edge DRAM and NAND, negative AND, a type of non-volatile storage technology that retains data without power, shipments to lower-tier, lower-margin devices. This regulatory wall creates an artificial ceiling on Micron's immediate growth. While the capital flows into the AI infrastructure layer are massive, policy decisions are actively reshaping where those dollars can be harvested. The macro environment is not a passive background. It is a violent wave of capital allocation and geopolitical friction. This regulatory friction is amplified by a volatile geopolitical landscape. The primary battleground is the global DRAM triopoly, a market dominated by three major suppliers, Micron, Samsung, and SK Hynix, which controls over 95% of global supply. This oligopoly is highly sensitive to geopolitical choke points. With ongoing Trump tariff uncertainty and renewed trade war fears, supply chains are under constant threat. If new tariffs are implemented, the cost of raw materials like high-purity chemicals and silicon wafers will spike, directly hitting Micron's gross margins. Furthermore, the battle for HBM, high-bandwidth memory, a specialized 3D stacked DRAM interface, supremacy is a geopolitical arms race. Currently, SK Hynix holds 58% of the HBM market, while Micron has overtaken Samsung for the number 2 spot. However, the geopolitical risk is concentrated in East Asia, where TSMC, Taiwan's semiconductor manufacturing company, the world's largest dedicated independent semiconductor foundry, manufactures the logic dies that sit beneath Micron's memory stacks. Any disruption in Taiwan halts the entire AI supply chain. This reality is driving a broader social and political shift, the urgent push for sovereign hardware supply chains. Western governments and enterprise customers are no longer willing to accept single point-of-failure risks in Asia. This social anxiety is driving the robotics supercycle and localized data center build-outs, creating a massive structural tailwind for domestic memory. Despite a sluggish recovery in consumer PCs and smartphones, tight industry supply on leading-edge nodes has enabled double-digit contract price increases. TrendForce reports that NAND contract prices surged more than 100% in the first half of 26, while consumer DRAM shortages are extending to older DDR2 products. The macro wave is pushing capital directly into Micron's physical infrastructure, but geopolitical bottlenecks dictate how much of that capital actually translates to net profit. The system-level friction is real, and it brings us to the final question of execution. The global race for silicon independence is no longer a luxury. It is a matter of national security. Micron reported earnings per share of $25.11, beating the Wall Street estimate of $21.40 by 17.3%. A solid beat that signals strong execution. Micron memory is trending higher at 1,132. Management's headline: "We have a strong leadership position in HBM," the line that drapes every slide and press release. It's meant to make investors feel the company is the undisputed king of high-bandwidth memory, while nudging them to ignore any hint of capacity constraints or pricing pressure hidden in the fine print. The lab tears that veneer apart. Insider Sanjay Mehrotra sold $57.4 million of stock in the past 90 days, the largest single-person outflow on the filing. Historically, such a magnitude of insider divestiture precedes a softening of guidance or a strategic pivot. The earnings beat, $25.11 EPS versus $21.40 estimate, a 17.3% surprise, looks dazzling, but it rides a one-quarter surge in HBM4 revenue that jumped past $1 billion, not a sustainable trend. R&D consumption rose to $3.8 billion, now 10.2% of revenue, up 10.7% YoY, signaling heavy cash burn to fund the 1-beta node and upcoming 1-gamma EUV transition. Analysts are cheering. Barclays lifted its price target to $2,000, Citigroup to $1,400, and Goldman to $1,100, all within the. Yet short seller activity spiked 1.41 times the baseline, a clear warning that sophisticated traders see a mismatch between the hype and the underlying risk. The only engineering reality that tempers the leadership claim is the 12-layer HBM3E silicon through-via yield, which the 8K filing does not disclose, but is known to cap wafer output at roughly 70% in early production, far short of the fully booked capacity the company touts. What moved the stock? The confluence of a glowing earnings surprise, aggressive analyst upgrades, and a high-profile insider sell-off created a tug-of-war between optimism and caution. What the lab hears is, management is shouting leadership while the hardware pipeline is still throttled by yield limits and insiders are cashing out. The language is tighter than the prior one. In Q2, the CEO said, "Record demand for HBM," a phrase that implied unlimited upside. He switched to, "We are very pleased with our HBM4 product," and then fell back on the boilerplate, "We are not providing specific pricing guidance." The shift from record to pleased and the added non-guidance disclaimer signal a retreat from overt optimism. Executives are buying time while the supply chain tightens. In the 10Q, the risk factor section expands on potential delays in advanced packaging yields and volatile ASPs for high-bandwidth memory, language conspicuously absent from the press release. That gap tells us management is bracing for a slowdown that the public narrative refuses to acknowledge. Watch for the next 10Q to reveal whether the R&D spend as a percentage of revenue slides below the current 10.2% threshold. A dip would indicate the company is scaling back its 1-beta/1-gamma node programs, directly undermining the leadership story. Conversely, if the MD&A adds a phrase such as "sustained strong demand for HBM4 with stable yields," the bullish thesis gains traction. The lab's verdict: the PR spin is a high-octane confidence play, but the underlying hardware constraints and insider sell-off expose a fragile foundation. The momentum breakdown for Micron. RSI sits at 63, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above zero. The structural bull case for Micron is anchored in a fundamental hardware supply-demand imbalance that Wall Street is still struggling to model. At $1,132.33, The stock is trading in the upper third of its 52-week range, supported by a powerful bullish MACD. Moving average convergence divergence, a trend following momentum indicator, crossover. The primary catalyst is Micron's capture of 20 to 25% of the high-margin HBM3E market. This high-bandwidth memory transition, combined with unprecedented enterprise SSD demand for the 6500 ION 30.72 terabyte drive, is driving record-breaking DRAM and NAND blended ASPs. Micron's forward PE, price-to-earnings ratio, a valuation metric comparing current share price to projected per-share earnings, of just 7.6 times makes it exceptionally cheap relative to its technology peers. This low multiple does not reflect the structural reality of a global memory oligopoly where demand is outstripping supply. But here is what breaks the bull thesis: the imminent threat of Samsung resolving its 12-layer HBM3E qualification hurdles. If Samsung achieves high-volume manufacturing approval, it will flood the market with supply, destroying Micron's pricing power and ending the current memory upcycle prematurely. The options market is already pricing in this risk. The put-to-call ratio has spiked to a highly bearish 2.10, with puts outnumbering calls by over 2 to 1, signaling that institutional players are hedging heavily against a sharp downside move. Furthermore, smart money is actively taking chips off the table. In the most recent 13F filings, Capital World Investors trimmed its position by 28%, and FMR LLC cut its holding by 19%. While analysts like Barclays are raising price targets to $2,000, these lagging fund trims show that large-scale asset managers are locking in profits at these elevated levels, wary of the historical boom and bust cycle of the memory market. Let us address the single question that cuts to the core of this entire debate. How can Micron maintain its 28.1% gross margin if SK Hynix maintains its 12 to 18-month packaging lead? The answer lies in Micron's proprietary thermal compression, non-conductive film packaging technology. While SK Hynix's mass reflow molded underfill process currently yields higher volumes, it faces severe thermal limits as stack heights increase to 12 layers and beyond. Micron's thermal compression technology allows for thinner individual silicon dies and superior heat dissipation. As AI accelerators push past 1,000 watts, thermal management becomes the ultimate system bottleneck. Hyperscalers will be forced to pay a premium for Micron's superior thermal performance, even if Micron's packaging yields are initially lower. This engineering advantage protects Micron's margins from commoditization. Our track record on Micron demonstrates the accuracy of this engineering-first approach. Our June 24th buy call at $1051.77 is up 7.7%. Proving our ability to identify post-earnings mispricings before the broader market recovers. The lab's conditional call is clear. If Micron successfully stabilizes its 12-layer HBM3E packaging yields by the fourth quarter of 2026, the stock will break through its immediate resistance at $1,213.56 and rally toward $1,255 on massive margin expansion. If Samsung secures dominant 12-layer qualification first, expect Micron to plunge to near-term support at $864.01 as the market price is in oversupply. Our AI score of 80 out of 100 reflects our high conviction that Micron's thermal compression technology will win the qualification race. Watch the sequential gross margin of the compute and networking business unit. A rise above 30% will confirm that the bull scenario is locked in. Here's the macro picture shaping Micron. The 2024 U.S. export control rule on advanced memory chips above 24 gigabits restricts sales to Chinese data center customers such as Alibaba and Baidu, forcing Micron to shift DRAM and NAND shipments to lower-tier devices. The CHIPS Act's $52 MU staggering 345.7% revenue surge eclipses every peer, making growth the decisive yardstick. Wall Street whispers that Micron's price is justified by AI hype, yet the numbers speak louder than any narrative. LRCX trades at $379.09, down 5.7%, with a 71.4 XP/E and 23.8% top-line gain. WDC sits at $586.45, down 12.9%, boasting a 35.1x P/E and 45.5% revenue lift. Micron, meanwhile, commands $1,132.33, a premium that cannot be defended by earnings multiples because its P/E is non-existent, implying negative earnings. The lab sees the core signal in Micron's 345.7% growth, a metric no competitor can match. Lam Research's sole advantage lies in its 50% gross margin, a solid cushion that Micron's data omits. That margin protects LRCX against cyclical demand shocks and underpins its 71.4x valuation. Western Digital's edge is its 45% gross margin combined with a respectable 45.5% revenue climb, delivering a more palatable 35.1x P/E. Both peers translate margin into cash flow, while Micron's missing margin figure leaves investors guessing about profitability. When we strip away the narrative veneer and focus on valuation, Micron's price is a stark outlier. With no P/E to anchor the $1,132.33 tag, the market is paying solely for speculative AI upside. LRCX's 71.4x multiple, though high, is anchored by earnings and a 23.8% growth rate, offering a clearer risk-reward profile. WDC's 35.1x multiple, paired with 45.5% growth, presents an even more attractive valuation curve. Micron's premium cannot be rationalized by earnings because the earnings base is absent. The premium is purely narrative-driven. Capital efficiency further tilts the balance toward the peers. LRCX's 50% margin plus 23.8% growth yields a risk-adjusted return that, at its current price, beats a speculative growth story lacking margin data. WDC's 45% margin and 45.5% growth combine to a compelling efficiency story, especially at a lower multiple. Micron's 345.7% growth is intoxicating, but without margin transparency, the risk-adjusted return collapses under the weight of its inflated price. The lab concludes that the market's pricing of Micron is disconnected from fundamental economics. Given the competitive landscape, Micron's current price is an overvalued gamble. Investors achieve superior risk-adjusted exposure by targeting Lam Research or Western Digital instead. Micron's HBM3E yields just hit 90%. That's the buy trigger Wall Street ignored. Would you start a position in MU here, add to an existing one, or wait? Give me your logic. This isn't financial advice. We're engineers, not brokers. Markets move fast, data gets stale, and past performance never guarantees future returns. Do your own research before pulling the trigger. Subscribe to the lab. We go deeper than any earnings call. If you want our full breakdown on NVIDIA, the link is in the description. Stay sharp, traders.